Welcome to the US Stockpicker Podcast channel name, US Stockpicker Podcast. Today we are unpacking a fascinating paradox in the market. Imagine looking at the undisputed king of traditional brick and mortar retail, a company known for massive supercenters, everyday low prices, and defensive stability. Now imagine that same company suddenly trading with the valuation metrics of a high-flying Silicon Valley software firm. It is a massive disconnect. We are looking at a mature business with steady, low single-digit revenue growth, but it is being priced for absolute perfection. The question we have to answer today is whether this is a brilliant evolution into a digital-first powerhouse or a classic valuation trap waiting to spring on unsuspecting investors.
That is exactly the tension driving the market right now. We are looking at a company that is fundamentally redefining its identity. The traditional narrative for this stock has always been that it is a safe harbor. When the economy gets choppy, consumers flock there for value, ensuring consistent foot traffic. But the market is no longer pricing it as just a cheap grocery store. It is being treated as a high-growth platform. The reason for this massive shift in perception comes down to operational efficiency and a pivot toward high-margin services. The core retail revenue only grew by about 4.7% year over year. That is steady, but it is certainly not explosive. However, their free cash flow growth is an absolutely staggering 228%. They have essentially turned their massive physical scale into an unprecedented cash-generating machine.
A 228% increase in free cash flow is the kind of metric that forces you to sit up and pay attention. It completely changes the capital allocation game. With that kind of cash generation, they do not need to take on expensive debt to fund their digital transformation. They can comfortably pay dividends, execute share buybacks, and heavily invest in automation and e-commerce all at the same time. But we have to address the elephant in the room. The stock is currently trading at a price-to-earnings ratio of 45.8. Historically, paying a multiple that steep for a company growing its top line at under 5% is a recipe for severe disappointment. If they miss earnings by even a fraction, the market could punish them severely.
You hit the nail on the head. That 45.8 PE ratio is the ultimate valuation overhang. It is very steep. The company maintains an incredibly strong return on equity of 23.7%, which proves management is highly effective at deploying shareholder capital, but the net profit margins are hovering right around 3%. That leaves virtually no room for error. If we see rising labor costs, supply chain disruptions, or if competitors like regional grocers or major e-commerce rivals initiate a price war, those thin margins could easily compress. If the market suddenly decides that a 45 multiple is simply too rich for a retailer, we could see a 10 to 15% drop purely from multiple compression, even if the underlying business continues to perform solidly.
It really makes you wonder about the broader societal shift in how we define a business. Are we reaching a point where physical retail space is essentially becoming a massive data collection and advertising network? Because to justify that kind of valuation, they cannot just be selling goods, they have to be selling high-margin services. And we are seeing exactly that with their strategic initiatives. They are aggressively pushing their advertising business and third-party marketplace. Plus, they recently executed a membership fee hike for their warehouse club division.
That fee hike is a critical piece of the puzzle. It is a pure demonstration of pricing power. In an inflationary environment, the ability to raise membership fees without triggering a mass exodus of customers is the hallmark of a resilient business model. It is a direct lever for margin expansion. And when you look at the sentiment data, the smart money clearly believes in this transition. Over the past 48 hours, the information consensus has been highly positive. We are seeing significant institutional accumulation. For example, Bank Pictet and CASA increased their holdings by an incredible 92.8%. That is not a short-term trade. That is high-conviction, long-term positioning.
Institutional buying on that scale is impossible to ignore. It is hard data showing exactly where the capital is flowing. And it is not just the institutions. We are also seeing insider alignment, with multiple corporate directors choosing to take their compensation in stock units rather than cash. When the people running the company are eating their own cooking, it sends a powerful message to the broader market. We also saw a recent strong buy upgrade from Erste Group Bank. While analyst upgrades are often lagging indicators, when you combine them with massive institutional buying and insider confidence, it creates a very stable, bullish foundation.
Exactly. The narrative has shifted from a defensive staple to a quality growth play, but we have to balance that long-term fundamental story with the immediate technical reality on the charts. Right now, the stock is trading around $125.79. It is in a very clear, healthy uptrend across multiple timeframes. On the daily chart, the price is sitting comfortably above all the major moving averages. It is above the 50-day at $124.28 and well above the 200-day at $108.88. That golden cross alignment is a classic bullish structure.
So the broader trend is undeniably strong. But for someone looking to deploy capital right now, timing is everything. If we zoom in on the near-term horizon, looking at the next 1 to 5 days, the momentum indicators are suggesting we might be a little overextended. The relative strength index on the 4-hour chart is pushing up near 62. It is not completely overbought yet, but it is approaching levels where short-term exhaustion typically sets in. It sounds like chasing the stock at current prices might expose investors to unnecessary short-term volatility.
That is precisely the read. The near-term signal is to wait. The stock is slightly extended from its 4-hour moving averages. There is a high probability that we will see a minor consolidation or pullback before the next leg up. General market choppiness, or even a buy the rumor, sell the news reaction to their upcoming dividend payment could easily trigger a quick drop. So avoiding market buys at the current level is the prudent move. The much more attractive setup is on the swing horizon looking out 3 to 15 days. The daily trend is so well established that any minor dip is essentially a buying opportunity to ride the broader institutional momentum.
That brings us to a crucial point in our discussion. We need to synthesize all of this complex data into a clear, actionable framework for our listeners. Before we wrap up, let's detail the exact strategy based on today's analysis. Let's walk through the specific call to action, covering the sentiment, the fundamentals, and the exact price levels for a swing trade.
Absolutely. Let's break down the call to action into our core pillars. First, regarding the news sentiment analysis. The sentiment is definitively positive and moderately strong, driven heavily by massive institutional accumulation and the company's proven pricing power through recent membership fee hikes. Second, on the fundamental analysis. The business is a cash-generating machine with a 228% growth in free cash flow and an excellent return on equity. However, the valuation is a concern. A 45.8 PE ratio means the stock is priced for perfection, so it requires careful risk management.
Third, looking at the swing trade analysis, the stock is exhibiting a robust bullish structure on the daily chart, supported by a transition in market narrative toward growth status. However, the near-term momentum is slightly overextended. Fourth, our buy and sell recommendation on when to start investing is to hold off on immediate market buys. You should wait for a minor pullback over the next 1 to 5 days to let the short-term exhaustion clear out, and then look to buy the dip for a 3 to 15-day swing trade.
Fifth, the specific price point to start investing is to place a limit order in the entry zone of $124.50 to $125. This aligns beautifully with the recent breakout level and the 4-hour support. Sixth, regarding when to leave the market. You should exit if the broader market experiences a severe systemic correction or if the technical thesis is invalidated by a breakdown in the daily trend. Finally, the exact price point to leave the market to mitigate risk is a hard stop loss at $122. That places you safely below the 20-day moving average. If the trade works in your favor, your upside targets to take profits are the psychological resistance at $130 and the yearly high at $134.69.
That is a masterclass in blending fundamental narrative with precise technical execution. It is a reminder that even the most established legacy companies can completely reinvent themselves. But as investors, we must always let the price action dictate our entry. Thank you for tuning in to the US Stockpicker Podcast channel name, US Stockpicker Podcast.
The information provided here and on this channel is for general informational and for education purposes only. It does not constitute investment advice, financial advice, trading advice, or any other sort of advice. We make no recommendations regarding investment decisions based on this information. You are solely responsible for your investments. Please conduct your own research and consult qualified financial advisors before any investing. Urgent. Is this retail giant the ultimate tech play? Stock Trade Podcast. Growth stock picks and upside potential stocks. Technology stock predictions for pop stocks.